Good afternoon, everyone. I'm David Canzior, a director with the CFA Society NZ. Before we just kick into things, I wanted to have just a quick plug for the Forecast event 2021 on next Tuesday on the 9th. We're dealing with COVID's impact on global asset markets. We'll be joined by Tobias Moskowitz, who's principal at AQR and also a professor of finance at Yale University. Today, however, we're delving into ethics. And who better to talk to us about ethics than the regulator? We've got a Q&A session at the end, so please enter some questions into the chat box below. We'll get around to those at the end of the session. At the moment, however, it's my pleasure to introduce our speaker, Clare Bolingford. She's a Director of Banking and Insurance at the FMA and leads the coordination and market engagement for expected conduct licensing regime of banks and issuers. She has spent a considerable amount of time for her career in the UK with the Financial Conduct Authority, the UK regulator, as well as Her Majesty's Treasury. Welcome, Clare.
Tēnā koe, David. Ana mana, ana waka, ana reo, ana rangitira mā. Tēnā koutou katoa. Today, I'd like to talk about the FMA's conduct expectations of financial services firms broadly. Essentially, it's not just what you do, it is how you do it. But first, just a quick introduction from me. As David said, I'm the FMA's first Director of Banking and Insurance Conduct, a role that was created last year in line with our new wider remit as conduct regulator for banks and insurers. I previously worked in the UK in both prudential and conduct regulation, really since the start of my career. But for me, financial services conduct has always been the draw. I think poor conduct can have such a significant negative impact on overall well-being, whereas financial services delivered well can have such positive benefits. But conduct isn't simple because it's about how people behave. I truly believe good conduct benefits firms, their customers, and the sector as a whole. Financial services provide real opportunities to make a difference to people's lives in a positive way if this is delivered in the right way. So why am I talking about conduct regulation in a webinar about ethics? Well, it's because regulating conduct is about monitoring and influencing the behaviour of the sector and individual firms over time. And why do we need conduct regulation? Well, conduct matters because it's what the customer experiences, and it's a key factor in whether they get fair outcomes from financial products and services. And the culture or subcultures within a firm are key influences on how that firm behaves towards its customers. Getting the culture settings right so that people do the right thing is more than a legal minimum requirement. We want entities to do the right thing because it's better for the customer, not because the regulator's watching. So what my team is trying to create within the banking and insurance space is a shared vision around fair customer outcomes. We do want to work with the industry through constructive engagement to achieve this and build mutual trust to facilitate transparent discussions, including when things do go wrong. We want to identify and promote good practice, but we do view this as a long-term journey that requires behavioural changes over time to fit in with the environment that we're all experiencing. And as the regulator, we will clamp down hard on poor conduct behaviour, as it's our job to hold firms to account for their practices and ensure there's proper focus on securing fair outcomes for their customers. To do this, I think there needs to be a change of mindset and approach in the regulation of financial services here in New Zealand. So one of the key differences I've observed in moving here is that New Zealand tends to have somewhat of a more legalistic approach, particularly to conduct regulation, than the UK does. Now, compliance with the law, of course, is of paramount importance. As a regulator, I'm going to say that. But we are asking for a shift in mindset, a move from a compliance-led approach to a conduct-led one. And what this means is a relentless focus on those fair customer outcomes, on what's actually happening in practice, not just what the letter of the law says. Now, these aren't new concepts I'm talking about. And in fact, Rob Everett, who's just departed from the FMA after 8 years here, made these comments on conduct in his first and also his last speech last week as CEO of the FMA. He asks that the financial services industry embeds the concept of interests of the consumer and integrity in all that they do, saying that these must be the very cornerstones of the industry. On culture and governance, he's asked leaders to consider these points which are particularly relevant to ethics and to conduct. As leaders, what behaviours do you model? Who do you reward? How do you motivate and incentivise? And what behaviour do you punish? He said that culture was critical and it needed to manifest itself in all core processes that drive customer and regulatory outcomes. So I'd like to talk a little more about our conduct expectations of financial services firms. And firstly, I want to talk about the principle of treating customers fairly. This concept is at the heart of the new legislation going through Parliament to introduce a conduct regime for banks and insurers. And it means having regard to customer interests through the full product and service life cycle, from that design at the beginning and distribution right through to post-sales interactions. It's about making sure that products are suitable for the customers that are paying for them, again, not just at the point of sale, but however long they hold that product for. And it's also about clearly identifying and managing actual and potential conflicts of interest that may disadvantage the customer. An example of this may be in the life insurance sector, where advice commission structures can create conflicts of interest for the advisors that have a choice as to which product they recommend to customers. And it could mean that if they are swayed in terms of how their incentive structures work, if they get a lot more money, for example, for selling one product over another product, that creates a conflict where they could actually advise the wrong product that isn't suitable for the customer at the end of the day. That's the kind of risk that needs managing, and that's what we're trying to guard against with some of these regulations. I also want to talk about firms ensuring that there's adequate governance and accountability to guard against poor conduct occurring. This is about how boards and leaders shape and drive the strategy and values underpinning the culture and conduct of the firm. These are the people that need to set the right tone for the organisation, and it's important that leaders are checking in regularly to ensure that their strategy and the tone that they're setting is having the impact that they expect and is being embedded effectively across the organisation. I think this means having a really good feedback loop from the bottom to the top of the organisation. If senior managers and boards are only receiving sales, revenue, acquisition and marketing reports, how will they know if their firm is also meeting its conduct obligations? And this also isn't just about words. The actions of leaders are more important and send clearer messages to their staff. An example of where the wrong messages are sent has been back in the news recently in the UK. So Jez Staley, who has just stepped down from being the chief executive of Barclays Bank in the UK, a few years ago, action was taken against him by the regulators because of a whistleblowing incident, where as the chief executive, having been told about a whistleblowing report in relation to one of his senior leaders, he actually used the security services of the Barclays firm to try and chase down who that whistleblower was. Now, you can see from a compliance perspective and in terms of what the whistleblowing policies and procedures are meant to achieve, you can tell what kind of behavioural messages that sent to the rest of the organisation in terms of his expectations and the importance of whistleblowing, effectively saying that whistleblowing policies weren't really being respected by the person at the top of the organisation. So to expand on the importance of governance, I do want to have a look at how firms use customer data and some of the ethical considerations that need to be made around that. So it's really crucial that firms have access to the right data and analysis to inform the decisions that they're making and to understand whether fair outcomes are being achieved. Boards do need to have visibility over what happens in practice, where things are going well, and where there have been errors or complaints. And this is really critical for good conduct and culture. Putting customers at the heart of the business is about understanding more about your customer than market share, the share of wallet, profit per customer, or even net promoter scores. So knowing your customer and understanding how they're experiencing products and services is critical. But we also know that using personal and sensitive data, which there's an awful lot of within financial services, comes with a responsibility. And so how data is used needs to be effectively governed and controlled. Now, the use of personal data in New Zealand is prescribed in the 2020 Privacy Act and regulated by the Privacy Commissioner, which sets out how everyone must comply with the legal principles on data and addressing what data can be obtained and in what circumstances. But what should be considered over and above the legal requirements? For example, where customers hold products for a long period of time, whose responsibility is it to make sure that the data the firm holds is accurate and therefore the product remains suitable? So for example, if a customer is holding an insurance product with age-related exclusions, so this could be a travel insurance product where they aren't covered for the insurance over the age of 75, for example. Is it the customer's responsibility to let the firm know that, or should the firm hold the data to make sure that the product remains suitable for all its customers, even if they are holding those products for multiple years over the lifetime of the product? So firms should be having a consideration as to how they can make sure that products do remain suitable for customers over time, and using the data that they hold to make sure that that's the case. Firms are also increasingly using digital communication channels, and those can also assist with data collection. But again, this needs proper thought and governance. There can be real benefits to the use of digital communication channels for the collection of data and for the efficiency of the services that are provided, but they do also create barriers for some consumers. A benefit can be making it easier for customers to disclose their needs through online platforms, or by using data analytics or software to identify drivers of customer vulnerability, which I'll come on to speak about a little more. But firms should consider how they support customers and take into account the needs and outcomes for those who can't or don't want to engage with digital channels. Now, how firms communicate with their customers is a really important principle for us and an important part of our conduct expectations. Again, this is about communicating through the lifetime of a product. For example, in relation to marketing, we've recently published guidance setting out 3 key principles for firms to consider when advertising financial products or services. The type of considerations are around what the overall impression is created by the advert when it's viewed for the first time, ensuring that it includes all relevant information, because omissions can be misleading, deceptive, or confusing, and any claims in the advertising must be able to be substantiated. As we said when releasing this guidance, advertising can significantly influence people's investment decision-making. So it's absolutely critical that firms' marketing materials don't mislead or confuse. We've asked firms to consider how their conduct actively assists investors to make appropriately and considered investment decisions so that expectations they have are realistic. The intent of the marketing, the why, is critical. Why are you marketing a 6-month performance period? Why are you blasting a fixed return in a social media panel which has very limited copy? We've recently taken action against Duval for misleading advertising, who I should note have appealed that. It doesn't matter how experienced an investor is or how experienced you believe them to be, you must still be careful not to be misleading or deceptive. How you try to get investors into your marketing web is also important. And in the Duval case, which was principally around the representations made in the adverts, the extensive use of social media, while not the key concern, was an aggravating factor. Because if a wholesale offer, which is what Duval were making, makes extensive use of broad public channels like social media, the intent to target experienced investors does become questionable. So we're now doing further work across a number of wholesale providers to find out what happens to investors once they arrive in the marketing web. For example, are pressure tactics being applied? But I'd also like to talk about another area, which I've touched on, where we've recently updated our expectations, how firms should consider their practices around customer vulnerability. As I said, in our conduct expectations, we highlight the importance of continual communication throughout the life cycle and not limited to one-off interactions. We also anticipate that these should be provided to vulnerable customers in easy to understand formats. Here we've worked with the Council of Financial Regulators, which includes fellow financial services regulators and ministries, to develop a framework, and then we provided additional pointers on procedures and examples of good practice. Like conduct, the concept of vulnerability, though, is not straightforward to implement in practice. The framework looks through the lens of circumstance rather than necessarily having it as a label for particular groups or demographics. We expect firms to have an in-depth understanding of their customer base. What specific drivers of vulnerabilities could their customers face? And drivers of vulnerability aren't uniform or constant and may differ according to time and markers such as demographics. Where data has identified drivers specific to a group, we do encourage firms to address these over and above the vulnerable customer support process and procedures we anticipate firms would have in place in the first place. And in terms of individual interactions, where a client has contacted a firm needing additional support, at a minimum, we would expect firms to keep a record of this, and this record to be available to any necessary front-facing staff to ensure consistency and responsiveness in the engagement that they have with the customer. I also want to talk about a really crucial part of our conduct expectations, and that is that firms have effective policies, processes, systems and controls in place to prevent poor conduct and pick up on any issues that may have a negative outcome for customers. And this is because in our culture and conduct reviews that were done a couple of years ago of the banking and life insurance sector, and more recently, we've conducted a review into the fire and general market, we found that there often weren't adequate systems and controls in place to prevent risks or indeed actual harms occurring to customers, even though in many cases that wasn't what was intended. Most poor conduct that we've seen over the past few years is not deliberate, but it is often the result of underinvestment in robust technology and processes and the failure to review these regularly, which are deliberate decisions by organisations. Investment and resourcing decisions should be looking at the longer term and potential impacts for all stakeholders, and not just a single dimension such as a financial return or regulatory or legal risk to the entity, to ensure that there aren't longer term unintended consequences for their customer outcomes. So for example, if you launch a new product, do you actually follow up to see if the product is being used by the type of customers you expected? And do you check over time to ensure that it delivers for customers as intended? We've seen this go wrong in the past, and indeed have released quite recently a report into the consumer credit replacement insurance, which we did see some quite poor practices in the past around sales tactics being used, the way that the distribution process was designed, which was leading to a number of customers holding a product that actually wasn't suitable for their needs. So it's really important to check whether products and distribution channels are working correctly. In the CCRI example, we've seen customers holding products that aren't suitable for them or that they can't use over a large period of time. So what happens if things go wrong, like in the CCRI case in some instances, and conduct risks are identified and consumers have been impacted? Well, our expectation is that customers are treated fairly by being put back in the position they would have been if the issue hadn't have happened. It's about being accountable when things go wrong and identifying why it happened, getting to the root cause, and then promptly fixing the issue and putting things right. It's also important to integrate any lessons learned into business practices to stop things like this happening again. Now, things can go wrong at many points. As I've said, we've seen quite a lot of issues in relating to poor systems and controls, but also from poor product design and sales practices, leading to errors. We've seen a number of examples of these in the banking and insurance sectors where firms have had to pay money back to customers as a result of these weaknesses. And that could be where fees have not been waived, discounts haven't been applied, or there has been overcharging. We expect firms to have good information and controls in place to identify any issues like this promptly, to understand those root causes of why the issue occurred and put customers back in the position it would have been. So what do we mean by fixing the problem? So the first step would be to stop the harm in a way that there's no further adverse impact on those customers. So for example, stopping overcharging or start by providing any agreed discount or benefit that the customer should have been receiving. Firms really shouldn't wait until they have all the information available on what might need to be paid back over the course of the product, the time that the customers held the product. because this can often take time, sometimes months, particularly with systems that may be more manual, to understand the full extent of an issue. And in this example, it would not be right to carry on overcharging a customer during that period. So in conclusion, consistently delivering on good conduct across an organisation and sector is not easy, but our expectation is that improvements in conduct need to be ongoing. We expect financial services firms to be reviewing their conduct and the supporting processes, controls and systems regularly to identify potential risks to customers and to mitigate these. The external environment and expectations of good conduct are rapidly and regularly changing in the public mindset. So firms do need to be ready to evolve their practices and adapt and improve as needed. The FMA is here to support financial services firms on their conduct journey and to make sure that investors and customers can have the trust and confidence in the sector and those benefits that financial wellbeing brings. Thanks very much. David, back to you.
Sure, thanks for that. Got time for the question and answer session now, if you like. So feel free to put that into Q&A box down the bottom or raise your hand. We can talk to you directly if you'd rather to. I thought just in terms of questions that I've got, you touched on a little bit on how you think, well, how New Zealand relates, I guess, to the UK. How do you think, have we struck the right balance in terms of broad principle-based ethics versus, say, legislated standards?
Yeah, it's a great question. So I think we're trying to strike the right balance with what we've got now. And I think across the financial services spectrum, there are differences in terms of the more rules-based regimes and the more high-level principles regimes. So I think, to my mind, in any regime, even one that is more principles-based, there still needs to be some clarity about what the expected compliance with the law is. So there will need to be some rules that people understand what those expectations are. And that's certainly the case for the conduct of financial institutions regime, where there are specific requirements that firms need to will need to comply with when that regime comes into force. However, if there are too many rules, then I think much more time could be spent trying to comply with those rules, and they indeed might not suit all firms. So you might end up with firms spending an awful lot of money to comply with the law, but to no actual benefit in practice. So I think there's a really challenging balance for legislators to strike between getting clarity and consistency, which really can only be achieved through rules, but actually making sure that it's able to be adaptable to any size or type of business that covers it as well.
Cool, thanks very much. We've also got a question from Robert. I see he's asked a question. I'll just pop him on speaker there. Have you got a question there, Robert? Hang on. Could still be on mute. Could have disappeared. It's all good. Maybe we'll come back to that later. Otherwise, feel free to type something in down the bottom. Another question I had, and again, this is probably a bit tricky, but interested in your opinion. So do you think there's actually been real change either in the UK or NZ in the banking and insurance sectors regarding better ethics, or are ethics breaches and paying fines just considered another cost of business?
That's a great question. I think, you know, it's been a couple of years now since I've been in the UK, but certainly there was a period there after the GFC where there were so many conduct issues being uncovered. And as I mentioned, so few ethical decisions being made that certainly, you know, we as the regulators felt might have come down on the wrong side of not only what we expect in terms of integrity, but also on the borderline of falling foul of some of the regulations themselves as well. So I definitely think that since the GFC, there has been improvement. I think that there was a period there where possibly the volume of issues coming through and the amount of work that needs to be done meant that potentially some of the firms did see enforcement action as a cost of doing business. Certainly there are one or two firms that I was supervising that that were almost perpetually in our enforcement division and had cases being brought against them, which does make not only the relationship quite challenging, but also working out how to move beyond, cleaning up the past legacy issues and moving forward with good conduct into the future. But certainly in the latter years, I saw firms really, I think, trying to make a real change to their cultures and their conduct. But of course, you are talking about a very broad sector. And you'll also always have, I think, a spectrum of good actors who are really trying to role model good ethics and good conduct. And then those effectively at the other end of that spectrum that are really out for themselves and maybe either really trying to walk the line between the law and making their own profits, or indeed are actively out trying to defraud people, for example. So that there will always be that spectrum, but that's part of the role of the regulator to try and pick up on the bottom end and to share good practice at the top end of that. I think in terms of New Zealand, I think the concept of conduct regulation rather than ethics, certainly in the financial service sector, has come a little later. So post the GFC, I don't think we kind of saw here quite the extent of the same legacy issues that we had in the UK. So there wasn't quite that push to focus on this as a risk. And I think it's been quite challenging to help firms to understand that conduct is a risk in the business, that they do have to focus on their culture, that they do have to focus on the behaviours and the experiences that their customers have, because the broad response we got really when Rob first went out and started talking about culture was actually, there's nothing to see here. We love our customers, everything is good. And it's really not until we start digging in, looking at practices and providing some of that evidence back, that firms have started to realise that they do need to actively manage some of these issues in practice. So I think there's some good work being done. We've seen some real progress since our culture and conduct reviews. But as I said, I think it's conduct is always a work in progress, and not one that you can take your eye off. So definitely more still to do.
A couple of questions that have rolled in. I'll just ask them. Of all the various broader elements and concepts mentioned, what specific areas or examples are you seeing where banks have the biggest maturity gap currently?
Oh, that's an excellent question. And I think it's probably, again, there's a bit of a mixed picture across the sector there in terms of maturity more broadly as well. So I would say that some of the sector have kind of got it and are really doing good work in areas like customer vulnerability that I mentioned in terms of use of customer metrics and data to inform their decision making. Whereas others are very much at the starting point of that journey. But I think I'd probably go back to a point I just made at the beginning, which is around mindset. And I think that the challenge that I have, and it could be just the people that I speak to on a day-to-day basis in the sector, but the challenge that I have is that banks quite often approach this conduct regulation as a legal risk to be managed, rather than necessarily focusing on that broader need to actually think about the customer and everything that they're doing. So what I see is that sometimes there could be some really great work going on in the compliance area, in the conduct space, even in the front line in terms of how they're working with their customers on a day-to-day basis. But then a product is launched and marketed and rolled out in a way that you think, how did that possibly get through the principles of good conduct, when it feels like you're selling in a way that has quite a lot of risk in terms of making sure that people have a product that's suitable for their needs, and isn't just driven by, if you like, the marketing department's desire to get something new and shiny out there into the marketplace and start selling it. So I think really ensuring that conduct is right across the organisation and not just sitting within pockets is one of those areas that we'd like to see more of.
There's another question whether you're able to comment on what strategies you're looking to implement to transition from a compliance approach to a shared focus in client-centric approach.
Yeah.
With regard to FAPs, I guess I should probably add.
Yeah, particularly with regard to FAPs. So I think it's fair to say this is an approach that we need to look inward as well as outward on. So I think previously the FMA has necessarily been focused in its monitoring activity to look at breaches of the law, breaches of the legislation. So when we come out to firms and we work, we work through our tools, our focus, while still on conduct and conduct risks, is actually to check on those compliance activities. And I think that the majority of the apart from in our culture and conduct reviews, the majority of the focus in previous years has been on those breaches rather than necessarily looking more broadly at conduct. So we ourselves need to develop the way that we regulate in order to support this transition from a compliance-led approach into a conduct-led approach. And one of the ways that we really want to do that is to engage more with industry, actually. So it's a bit more resource intensive, it's fair to say, but what we're very keen to do is actually have more conversations, whether that be through workshops, getting out there with industry associations, getting out there to run roadshows, and actually talk through what does this look like in practice? Have a shared experience with the industry where actually industry is coming forward and saying, this has worked really well for us. Does that meet your expectations? And is that something that can be shared more broadly? So we're really looking, rather than just looking to the bad practice and to the breaches that we've done previously and reporting on those, is actually trying to lift up the good practices we see. And we'd really love it if industry also did more to share those across the piece, so that others can learn how to implement this client-centric approach as well. So that engagement is really important to us, and I think learning from each other is always a great way to get good practice going right across the sector.
We've got another question sort of related to that alignment of practices, but this is more looking at what's the difference between the New Zealand and the Australian approach in terms of conduct and regulations, and is there an impact for Australian financial products available to New Zealanders?
Yeah, that's it. So I think there is quite a difference between the New Zealand approach and the Australian approach, and some of that is about the history of the two countries and the way that legislation has come about. But I think what we've tried to have is more of a balance here in terms of how we're implementing some of these conduct regulations. So I haven't worked in Australia, so I don't have personal experience of how the regulators work over there, but obviously we do now work closely with them in the run-up to the implementation of the banking insurance conduct regime. And I think it's fair to say that in the run-up to the Australian Royal Commission, that there was possibly more focus on the regulator's role in terms of how corporates were behaving, but not necessarily in terms of financial services conduct specifically. And some of those issues were brought to light within the Australian Royal Commission. I think when we considered the Australian Royal Commission and obviously some of the very poor conduct that emerged out of there, the obvious conclusion is, that we've got quite a lot of Australian firms who serve New Zealand, so therefore surely that poor conduct is here as well. And that really was the purpose of the culture and conduct reviews that we did, because we weren't getting the same level of complaints. We weren't seeing the same types of issues emerging time after time after time in the markets here. And although there were certain products that we had concerns about, and I've mentioned one of them, which is the consumer credit replacement insurance, where there have been issues in multiple jurisdictions, and certainly here as well, as you can see from our report, we really weren't seeing that level in other products of indicators that there was significant misconduct going on across the marketplace. And what the culture and conduct reviews did really was to explore what was happening in practice. I would say it probably only scratched the surface of what was happening in practice, but nonetheless, an awful lot of work and monitoring went into seeing what the banks were doing in practice, and particularly whether some of those harms were happening here in New Zealand. And what we actually found was that, apart from in a few instances, mostly errors were happening rather than misconduct. So it really was there's a lot of manual processes that take place that means errors can occur over time when it comes to how customers are being served. And that's what we saw the main issue being. So in our reviews, we do make a number of recommendations, which part of which has been what I've talked to today, a number of recommendations about how those can be fixed, including proper investment. And there's still a reasonable amount of work to do, I think, for firms to make sure that they're really tightening up and making sure that these issues have things will always go wrong, but have limited ability to occur again because there are proper controls in place. So I'm not quite sure if that answers the question, but I think that there certainly is a difference between what we've seen in Australia and what we see here in New Zealand.
Yeah, no, that's really interesting. Thanks. We've got another question from someone who looks like they've got a bit of experience on the wholesale side of investments through their work, but in their personal capacity, they are a retail customer, of course. Also, so they've got a few questions around the saying it's harder to get access to risky or innovative products on the retail side because anything of that nature is more designed to be wholesale. So, what's the FMA's thinking in terms of boundaries between wholesale and retail clients in the future?
Yeah.
And how do they access something more exotic if they want a sort of single strategy crypto fund that they want to put all their money into, as long as they accept the risk as a retail investor and it's fairly put up front, so what's available for them in the future?
Yeah, no, I think obviously we want customer choice out there in the marketplace, but we also want proper protections, which is why there are rules in place about the marketing of wholesale based funds to retail investors or not, but there are rules in place around what people are able to do there. So I think from the FMA's perspective, we haven't made any recommendations in relation to the legislative settings that we've got in place. But what we're looking to focus on is effectively, as I talked about, is how wholesale firms are actually behaving in the marketplace and whether they are actually trying to attract not retail consumers who have lots of experience in investing, understand the risks, but actually targeting retail investors who aren't. We've certainly seen it many times in the UK, and I know that we've seen it in New Zealand, that people really struggle sometimes to understand, particularly through different forms of marketing, what the real risk is, and particularly where they're not getting advice. So we are seeing a rise in certain demographics using social media, for example, as their only advice tool, which is great for them. That's where they get their information from. But actually, if they're getting the wrong information and if they get a surprise when products don't behave in the way that they expect, then that's an issue. So what we're trying to do really is help firms to understand what the legal expectations are, what our expectations are around how they conduct themselves in this space in particular. As I said, we're doing a little more work on this to see what's happening in practice, but we haven't made any recommendations around any legislative change in this space to the settings that we currently have.
A related question to that, as well as around whether you think people are skirting around the sort of wholesale retail divide. Someone's got an example of ads on the radio for unlisted mortgage trusts and property syndicates. So if it's obviously over the radio platform, then it's probably more aimed at a retail audience. But if you have the asterisks, wholesale investors only, same thing with social media, do they not have to comply?
Yeah, so this certainly comes back to the point that it might tick the box as far as having that asterisk, and wholesale investors only should apply as far as the legal minimum is concerned. But we are doing some more work into what the marketing practices are. So when I was talking about that marketing web and how people get drawn into that, we do want to make sure that firms are acting appropriately. And I think we are questioning whether, blanket, very broad adverts across public media channels are somewhat questionable in terms of the intent of the firm to draw in not only wholesale customers to that. So we are doing further work in the space to just test what's happening in practice, and we'll come out with the results of those tests, I would think, early next year. But it's a concern for us because clearly people are getting interested in these very public ads, even though they might not be eligible to participate.
Does that sort of result in more guidance or sort of legislative side of things in terms of legal avenues, I guess?
Yes, well, I think what we're keen to understand at the moment is what the practice is, and then we can think about what the right tools might be if there is poor practice out there to address. So yes, possibly more guidance in this space if there are still poor practices.
Cool. Well, I don't see, oh, hang on, another question has just come in. Question regarding whether you've got any concerns about poor customer outcomes outside the proposed COFI regulatory perimeter.
Well, that's a good question. Always have concerns about poor customer outcomes outside of any perimeter, but obviously our focus needs to be largely on those firms that are either licensed by us or are soon to be licensed by us. So I guess I'd be quite interested to hear if there are particular areas outside the perimeter that Clive might like to discuss further. We're always quite focused on what's happening around our borders, if you like, so around that perimeter, and certainly we do occasionally step into areas where we feel that more research is needed in order to understand whether poor conduct outcomes are occurring. This is indeed exactly what we did prior to COFI in the banking and insurance space, where we don't have legislative remit, but both the Reserve Bank and the FMA agreed that there should be these reviews done to ensure that we really understood what the marketplace was like after the Australian Royal Commission. And obviously legislation has now been brought forward to address the regulatory gap that there was there. But if people have got particular concerns about sectors that aren't covered by the perimeter, very interested to debate that further.
Yeah, I'm sure you're always interested in getting feedback, so I'm sure you can get in touch. Last chance for any other questions, otherwise I think we'll probably just wrap this up. I think you've covered quite a lot today, so thanks very much for your time. It's definitely been a bit of an eye-opener. It's been quite good actually because I guess a lot of CFA candidates and CFA Institute, there's ethics is more of a principles-based big document that you can get tested on, getting a practical side and understanding how the regulator thinks of things in the practical setting has been very, very handy. Thank you.
Right.
Just like to wrap up and say thanks very much for your time, much appreciated. Like to have you on again sometime in the future. Hopefully we can see where 2022 and 2023 are going.
Absolutely, we'd love to come back on and maybe next year when we've got a bit further on with the legislation as well, so that'd be super.
Yeah, that sounds really good. Thanks very much for your time today.
Thank you.